So we started this chapter on international corporate finance last week. The main topic here is we want to understand cross-country transactions and valuations. We started from the first section, which talks about the internationally integrated capital market. This is really a benchmark framework, or it's a starting point. So we want to think about a ideal world, right? A perfect world. And in this world, capital markets, they're internationally integrated. And we specifically talked about what you can get from this assumption. Basically, we talked about this valuation problem. That is, we consider a Canadian investor buying a foreign asset. In this case, this investor wants to understand how to value this asset. And we discussed that there are basically two approaches. The first one, which is the simpler or more obvious one. That is, you will first discount the foreign cash flow using the foreign cost of capital. And then, after getting this present value in the foreign currency, you will convert the present value back to Canadian currencies using the spot exchange rate. And then the second way, you will first convert foreign cash flows into cash flows denominated in Canadian dollars. And then you will discount Canadian dollars with the domestic cost of capital. That is the cost of capital in Canada, right? So basically, you can think it's a two-step process, and there is always this currency conversion. And then the main difference is in which step this currency conversion would happen. So in the first case, right, the currency conversion happens in the second step. That is, you will convert your present value in foreign currency into Canadian dollars. So this happens at the second step. And then in the second method, the conversion happens in the first step. Right? Okay. And based on this, we get a formula, which is this thing here. So basically, this is the first method, right? You're discounting foreign cash flow at the foreign cost of capital, and then you convert this present value into Canadian dollars using the spot exchange rate. And then this is the second case, right? So in the second case, you convert the foreign cash flow using the forward exchange rate into Canadian cash flows. And then you will discount Canadian cash flows using the Canadian cost of capital. And in the end, we will get a formula which is similar to this covered interest parity in chapter 30. So from chapter 30, we learned covered interest parity is given by this formula, right? And the difference here is in this chapter, right, we get this R star CAD. And this is the cost of capital in Canada. And for the covered interest parity from chapter 30, this guy is the risk-free rate in Canada. Right? So basically you have two different kinds of interest rates in these two formulas. Okay. So to summarize, basically, internationally integrated capital markets refers to the case any investor can exchange currencies at the spot or forward rates and is free to purchase or sell any security in any amount in any country at its current market price. Okay, so let's look at this Oops, sorry. I have to reopen this lecture note. Oops. Oops. Okay, so let's see this example here. The present value of Japanese yen, JPY, so the present value of the Japanese yen cash flow is 10 million JPY. Oh, oops, sorry. This is the answer. So let me read the problem first. Okay, so let's say you're a Canadian investor and you try to calculate the present value of $10 million JPY cash flow, which will happen in 1 year in the future. So you know the spot exchange rate is S equals 110 JPY per Canadian dollar. And the 1 year forward rate is 105.8095 JPY per CAD. And you also know that the CAD cost of capital is 5% and the JPY cost of capital is 1%. First, what is the present value of the 10 million JPY cash flow from the standpoint of a Japanese investor? Okay, so this one is pretty simple, right? Because it's really a very simple valuation problem. The only difference here is you have to think about currencies, right? You have to think about spot exchange rate and forward exchange rate. So the basic idea is if you want to exchange currency today, then you will use the spot exchange rate. And if you want to exchange currency in the future, obviously you should use the forward exchange rate, right? Because forward exchange rate is essentially the exchange rate in the future. So we know that this investor is expecting to receive $10 million. No, sorry, it's not $10 million. It's 10 million JPY in 1 year. And today's spot exchange rate is 110 JPY per CAD. It's also very important when you're looking at exchange rate, it's important for you to look at the units, right? So here it's JPY per CAD. Obviously, sometimes you can see a different case. You could see something like, let's say maybe 0.1 CAD per JPY. This is also exchange rate. You just need to be careful with the units here. Okay, and the forward rate is 105. So it's 105.8095 again JPY per CAD. And then we have discount rates, right? So in Canada it's 5% and in Japan it's 1%. And now the present value of the $10 million JPY cash flow from the perspective of a Japanese investor, well, this one is really simple because you will just discount this 10 million JPY cash flow using the cost of capital in Japan, right? So it should be 10 divided by 1 plus 1%. So this should give you, okay, so this gives you 990 JPY. So that's the present value. What is the CAD equivalent of the above amount? Note that this is present value, right? So it's the value today, which means if you want to convert this amount into Canadian dollars, you should use spot exchange rate. Right? So here, okay, let's call this as first problem, second, third. So for the second problem, you should use spot exchange rate, which is 110 JPY per CAD. So here, you wanted to use the amount in JPY divided by spot exchange rate, which is 110, which gives you the amount in Canadian dollars. It should be 90009 CAD. So again, you have to pay attention to the units, right? Because here you want to exchange JPY into CAD, and the exchange rate is expressed in how many JPY per 1 Canadian dollar, right? So you should use this JPY amount divided by this 110. Okay, the third one. What is the present value of the 10 million JPY cash flow from the perspective of a Canadian investor who first convert the 10 million JPY into CAD and then applies the CAD discount rate? So first you have to convert the cash flow, which should be 10 million divided by the forward rate. Now you have to be careful. Now you should use the forward rate because here the conversion will happen in the future, right? Because as a investor, you will only receive your 10 million JPY cash flow in the future. So in this case, it should be 10 million divided by, so what's the forward rate here? So it's 105.8095. And this should give you the expected future cash flow denominated in Canadian dollars. And now you can use the Canadian discount rate, which is 5%. So this should give you the same number, that is 90009, right? So if you look at this problem, it's exactly what we discussed in this chapter. That is, you have two ways to calculate the present value of a foreign project. So in question 1, what you're doing is you're calculating the present value of the project in JPY, in foreign currency. And then you will use the spot exchange rate to convert the present value in foreign currency into present value in domestic currency. And then for problem 3, it's the second method we discussed. You would first convert the foreign cash flow into domestic cash flow. And then you would discount the domestic cash flow by the domestic cost of capital. Right? Obviously, in the perfect world of internationally integrated capital markets, these two methods should give you the same answer. Okay, so let's move on to the next section. So here we wanted to go into details on the valuation of foreign currency cash flows. So in section 1, we basically discussed the basic approaches or the framework of valuing foreign currency cash flows. In this section, we will go into more details because there are several caveats you have to pay attention to. So we have discussed this. There are two ways of calculating the NPV of a foreign project. The first is you will calculate the NPV in the foreign currency and then do the conversion. The second is you will first do the conversion by converting the cash flow into the local currency, and then you will do the NPV calculation, right? And then we'll focus on the second method, and we will just use the first method as a robust check. We want to focus this second method because the first method is really close to the approach you have learned in Corporate Finance 1. And the first method has only one additional approach. That is, you have to convert present value or net present value into a local currency at the spot exchange rate. Right? So it's just a one trivial step compared with what you have learned in Corporate Finance 1. And the second one is more complicated and is newer. So we want to focus on the second one. And we can obviously use the first method as a robustness check because we understand in this internationally integrated capital market, these two methods should give you the same result, right? Okay, so let's look at this example here. Wow, this is a weird name. Idyesi. I guess it's Idyesi. Okay, whatever. So Idyesi, a Canadian firm, wants to apply the WACC method to value a project in the UK. Remember we learned about the WACC method, right? We know that there are basically three steps. First, you have to find out the cash flow. Second, you have to calculate the WACC. Third, you will discount those cash flows with WACC. Right? So it's a very simple and straightforward method to do valuation. So let's say the project only has a life of 4 years. The annual sales will be 37.5 pounds million dollars per year. And the manufacturing costs and operating expenses will be $15.625 million per year and $5.625 million per year. The project will require a capital expenditure of $15 million pounds, and a initial market expense of 4.167 million pounds. Corporate tax rate is 40%. As I said, we want to first find out the UK project's free cash flows, right? And to do this, we have to look at the income statement, and then we will do some adjustment to get the free cash flow. So first, the goal is we want to find out the unlevered net income because we learned about how to calculate free cash flow, right? We know that a firm's free cash flow equals unlevered net income plus depreciation minus capital expenditure and minus the increase in net working capital. Right? So for the first step, we will just look at this income statement, right? So we have sales in the top line, and we have COGS. COGS would be given by this number, right? So this is COGS. And then we have gross profit, which is basically sales minus COGS. And then we have operating expenses. So for year 0, the operating expense would just be the marketing expense. So this is the initial operating expense. And then in the future, the firm will incur $5.625 million of operating expenses per year. And then depreciation. Well, because we have a capital equipment of 15 million pounds, and we have a 4-year time span for this project. So let's say we use the simplest straight line depreciation method, right? So under this depreciation schedule, you can see that the per year depreciation should be the total amount divided by 4. So this gives us 3.75. And then after getting these numbers, we can find out EBIT. And then we can calculate the income tax. So what you see here is essentially the first year, because the EBIT is negative, so there is a tax shield because from this negative EBIT. And then finally we can get our unlevered net income. I mean, essentially unlevered net income equals EBIT times 1 minus corporate tax rate, right? Or you could say unlevered net income is the after-tax EBIT. Okay, and after getting the unlevered net income, we could make some adjustments to get the firm's free cash flow. So we would plus depreciation, which are just these numbers. And then we have to minus capex. And we know that the capex is 15 million pounds. So in the end, we could find out the firm's free cash flow in pounds. Right? So basically, initially, there would be a cash outflow of 17.5 million pounds. And over the next 4 years per year, the firm will have the free cash flow of 11.25 million pounds. Okay, now we have our free cash flows in pounds. So what's next? Should we proceed to find out WACC and do the valuation? Well, no. We have to convert the free cash flow in pounds to free cash flow in Canadian dollars. Right? So this is the extra step you have to take when you're thinking about the international corporate finance, right? This is the difference here. You have to think about currency. So let's say, we also have learned if you want to convert future free cash flows, then you have to use the forward exchange rate, right? So normally what you would do is you would get a forward exchange rate and do the conversion. So generally, if you look at actual data, actual financial market data, you can actually get like overnight forward exchange rate, and you can also get 10-year forward exchange rate, right? So this basically means you can lock in the exchange rate in 10 years. But here we want to take some extra step. So let's say you cannot obtain this 4-year forward rate quotes, right? Because you can see that here for convert this free cash flow, the 4th year free cash flow in pounds into the free cash flow in Canadian dollars, we have to find out the forward exchange rate in the 4th year. So let's assume you cannot obtain the 4-year forward exchange rate quotes. Let's say it's just too far away, right? Let's say this kind of quote does not exist. Then how do you get this quote? Well, you can actually use the covered interest rate parity from chapter 30 to compute the forward rates. Because we learned from chapter 30, the purpose of covered interest rate parity, at least in this class, is about how the forward rate is determined. Right? This basically means giving correct inputs, you can find out the forward exchange rate, no matter how far away the forward exchange rate is. Okay, so let's review or let's recall what we have learned in chapter 30. So in chapter 30, if you go back to the lecture note and if you look at the formula, you will get this formula here, right? So basically, in chapter 30, we discussed the covered interest rate parity based on US dollars and Canadian dollars. And you will get a formula like this. That is, forward rate equals spot rate times 1 plus interest rate in the US divided by 1 plus interest rate in Canada. As I said, it's important to look at the units here. So for the forward exchange rate F, the unit is USD per CAD, right? That is, if you get F USD per CAD, then correspondingly, this spot exchange rate should also be USD per CAD. And here you will have interest rate of USD in the numerator and interest rate in CAD in the denominator. But if you change the unit, so let's say now we have FCAD per USD. Now you have to use this spot exchange rate, which is in CAD per USD. And this interest part has to change, right? Now this CAD should in the numerator, and this USD interest rate should in the denominator. So it's actually pretty easy to memorize this. So if you look at the unit here, it's USD per CAD. So if it's USD per CAD, then USD would be here, and CAD would be at the bottom, right? For the second formula, CAD will be here on the top, and USD will be on the bottom, right? Okay, so that's for the 1 year covered interest rate. And we also learned the formula when we have multiple years, right? So if we have multiple years, then it's also easy to do the computation. What it would do here is you have this exponential here, right? With exponential t, then you can calculate the forward exchange rate in tth year. Okay, now we have to move from the version we have learned in chapter 30 to the version in chapter 31. The reason is because in chapter 30, as I said, we discussed the exchange rate between Canadian dollars and US dollars. But here, we're thinking about the Canadian dollars and British pounds, right? So we have different currencies. And the covered interest rate parity would be quite similar, right? So here you can see that the forward exchange rate in terms of CAD per GBP equals the spot exchange rate CAD per GBP times 1 plus interest rate in CAD divided by 1 plus interest rate in GBP. Okay, so now let's assume the current spot exchange rate, this guy here. This guy is 2. And then we assume the interest rate in Canada is 4%. And then the interest rate in the UK is 7%. So we have all our inputs, and then we can find out the forward exchange rate in 1 year. So it should be, it's given by this. So it should be 1.9439 CAD per GBP. And now we can continue use this formula into the 2nd year, 3rd year, and 4th year, right? Because we know that if you have more than 1 year, let's say if you have 2 years, you will just make sure t equals 2. And here, in the 2nd year, we will continue to use the formula, get the 2nd year's forward exchange rate, and 3rd year's forward exchange rate, and 4th year's forward exchange rate. This one should be F3. Okay, so after getting these 4 forward exchange rates, we can use these 4 different forward exchange rates to convert future cash flows in British pounds into cash flows in Canadian dollars, right? So we have got these cash flows in British pounds. And then we can do the conversion here. So note that for this exchange rate, its unit is CAD per GBP. So if you want to convert from GBP to CAD, then you should use the free cash flow in GBP times this forward exchange rate, right? So that's why, let's say for this date, right? So after the conversion, the free cash flow in Canadian dollars would be $35 million. Okay, so that's for the first step in the WACC method, right? Find out the free cash flow. The only caveat here, compared with previous chapter, is you have to do the currency conversion using the forward exchange rate. And then the further complication is, if I don't tell you what are the forward exchange rates, you have to solve the forward exchange rates using the covered interest rate parity learned from chapter 30, right? Okay, next, second step, we will try to solve the firm's weighted average cost of capital, right? So we need to find out WACC. And now you should be very familiar with how to calculate WACC, right? So basically you should use the portfolio weight of equity times the cost of equity plus the portfolio weight of debt times the cost of debt. And don't forget you have to use the after-tax debt cost of capital, that is RT times 1 minus corporate tax rate. So we have the firm's market value balance sheet here. What you can see here is the equity value would be $300 million. What is the market value of debt? Well, it looks like it's 320. But don't forget, this firm has cash. And whenever you're calculating WACC, you should use net debt. Net debt basically is calculated as debt minus cash, right? Because cash is like negative debt. So that's why you should use debt minus cash to get your net debt. Okay, so net debt would be 320 minus cash 20. So this gives you 300 plus 300. So 6%. Oh, sorry, the equity is actually 10%. Okay, and then the debt cost of capital is 6%, and the corporate tax rate, I guess it's 50%. Okay, so corporate tax rate is 40%. So it's 40%. And then this gives us a cost of capital 6.8%. So note that this WACC is the cost of capital in Canada, right? Okay, now we could finally do our valuation. So we have cash flows. And then we also have cost of capital, which is WACC 6.8%. So clearly you can calculate the present value, right? The present value would be these cash flows discounted at this 6.8%. And then the third cash flow. And last, the fourth cash flow. And this would be $71.506 million. Okay. What's next? Oh, NPV, right? We want to find out the net present value. This one is pretty simple. So you would just use present value minus $35 million. I guess it's 40 something. So it's 40.506. Okay. Okay, so to summarize, right? First, cash flow. Second, WACC. Third, discount cash flows using WACC. And the only difference is you have to do the currency conversion using forward exchange rates. And sometimes when the forward exchange rates are not given, you will use the covered interest rate parity to find out forward exchange rates. Okay, now we go back to the first method. Recall that the first method basically says you will first discount UK's cash flow using the cost of capital in the UK, and then you will get the present value in this UK currency in pounds, right? And then you will convert the present value in pounds to present value in Canadian dollars using the spot exchange rate. So this seems like a pretty simple process, right? But you will see that it's not that simple. There is one complication. And also the purpose of using the first method to do the valuation is we want to use the first method as a robust list check. We want to see at least in this perfect capital market, the first method should yield the same result as the second method. And in terms of how to solve this problem or how to use the first method to find out the net present value. So if you go back to the table, you can see that we have already got the free cash flows in GBP, right? So what we need is the cost of capital in the UK. And if we have that number, we can discount these GBP free cash flows with the cost of capital in the UK. And that will give us the present value in GBP. What is the spot exchange rate? Well, we have the spot exchange rate here, right? So we basically have everything except the cost of capital in the UK. Now, how can we find out the cost of capital in the UK? Well, here we will use a, here we will use a different way compared with CAPM, right? So here we will think about the covered interest parity, and we will use the covered interest rate parity to find out the cost of capital in the UK. So remember in last class, in section 1 of this lecture, we learned about this result. Okay, you might have forgotten this. But if you look at the prior lecture notes, what you can see here is the forward exchange rate equals the cost of capital in Canada divided by the cost of capital in a foreign country times the spot exchange rate. So the idea here is if this foreign country specifically refers to the UK, then the formula would look like this. Right? So if you don't know what is this cost of capital in the UK, what is this number, then you can essentially use this formula to solve the cost of capital in the UK. Right? So if you do some mathematical manipulation, you can actually solve the cost of capital in the UK. You can find out the cost of capital in the UK equals, I think it should be F divided by S, 1 plus the cost of capital in Canada, and we have 1 minus 1, right? And furthermore, you can see that we have this number, right? We have this number. We have just solved WACC in Canada is 68%, right? And how do we find this one? Well, you can solve this from covered interest rate. Because from covered interest rate parity from chapter 30, we know that F equals 1 plus RCAD divided by 1 plus R GBP times S. So here you can see that F divided by S equals the risk-free rate in Canada divided by 1 plus the risk-free rate in the UK, right? So we can use the risk-free rate in the two countries to find out the ratio of forward exchange rate and the spot exchange rate. And then we can get all the numbers we need. We can solve the cost of capital in the UK. Okay, I guess that's a little confusing. So let me go to the lecture note. Okay, so This is the formula we learned from section 1. And this is the formula we learned from chapter 30. And the purpose of this formula is we want to use the risk-free rate in the UK and the risk-free rate in Canada to find out the ratio of the spot rate versus the forward rate. And after getting this number, we want to plug in this number into the first formula. This will help us to solve the cost of capital in the UK, right? So in the end, if you plug this ratio of spot rate and forward rate into this first formula, you will get a formula like this. So basically it says, if you tell me the cost of capital in Canada and the risk-free rate in the UK and the risk-free rate in Canada, I can tell you the cost of capital in the UK. Right? Okay, so let's see this example here. The current spot exchange rate is S equals 2 Canadian dollars per British pound. And the risk-free rate in Canada is 4%. And the risk-free rate in the UK is 7%. And the Canadian cost of capital, RWAC, equals 6.8%. And we have the free cash flow in GBP. Now calculate this firm's GBP WACC. Well, we will use this, right? We will use this formula we just learned. So what's the name for this? Let's use WACC GBP, right? I guess the notation here is a little confusing. So this guy refers to the cost of capital in the UK, and it's the same thing as WACC GBP, right? So these two notations are the same. Both of these two notations refer to the cost of capital in British pounds. So it equals 1 plus the risk-free rate in the UK, which would be 7%, and the risk-free rate in Canada, which would be 4%. And then 1 plus the cost of capital in Canada, 6.8%, minus 1. And this gives us 9.88%. And the second question says, verify that the NPV of the firm's project is the same when its GBP free cash flows are discounted at this WACC and converted at the spot exchange rate. So if we discount these four cash flows, right? So it's 1 plus this plus this squared, and then you will discount all the other two cash flows. Okay, so if we check the answer key, the present value of the discounted cash flow in British pounds would be 754 million GBP. So the NPV would be this discounted value minus the first period cash flow, 7.5, which would be 18.254 million dollars. Million British pounds. And then we have to convert this net present value into Canadian dollars using spot exchange rate. So 18.254 times, I guess, the spot exchange exchange rate is 2 CAD per GBP. So this would give us 36.508. Okay, let's move on to the third section. So third section is pretty simple. We basically talk about international taxation. This is actually pretty important and controversial topic because of the specific laws on international taxation. A lot of firms, especially in the US, a lot of US firms, they park large amount of money offshores to avoid paying corporate taxes. Okay, so we basically think about the following case. So let's say there is a Canadian firm. Let's say it's the same Yesi. Oops. So it's the same Yesi firm. So this firm is a Canadian firm. However, it has a UK subsidiary. And in this case, let's say this UK subsidiary can generate 100 million profit. In this case, if this Canadian firm repatriate the profits from UK back to Canada, right? In this case, income taxes must be paid to both the UK government and the Canadian government. So here we refer to the UK government as the host government. The reason is because UK is the host to the Canadian firm's subsidiary, and Canada is the home country because in the end, Yesi is a Canadian firm. So you can see that in this case, you have to think about tax credit to avoid double taxation, right? As this Canadian firm brings income from the UK, you can imagine that after paying tax in the UK, this UK tax liability will become tax credit in Canada to prevent double taxation. Okay, now we first start with the simple case. Let's assume the Canadian firm has just one single foreign project. And we also assume all foreign profits are brought back to Canada immediately. So basically, we're ruling out two more complicated cases. We're ruling out the case the firm has projects in multiple foreign countries. We also rule out the firm can defer repatriating its foreign profits. So in Canada, the tax policy stipulates Canadian firms would pay tax on their foreign income at the same rate as profits earned in Canada. And then a tax credit will be given for foreign taxes paid up to the amount of the Canadian tax liability. So the key word here is up to. You will see very simple examples to help you to understand this this wording here. What does up to exactly mean here? So let's think about two cases. Say in the first case, the foreign tax rate is less than the Canadian tax rate. So let's say we think about U.S. right? Let's say U.S. tax rate is 25%. Let's say Canadian tax rate is 30%. Now, in this case, the Canadian firm will pay total taxes equal to the Canadian tax rate on its foreign earnings. So in this case, all of the firm's earnings are taxed at the same rate, the same 30%, no matter where they are earned. Okay, let me give you an example. So let's say we are looking at a Canadian firm, right? And then it has a subsidiary in the US. So let's say this US subsidiary repatriates $100 million back to this parent firm in Canada. Now, how the tax will be calculated? Well, first, in this case, the firm has to pay tax to the US government, right? And US's tax rate is 25%, which means here the firm has to pay $25 million of tax to the US government. And after repatriating $100 million back to Canada, right? In this case, supposedly, the firm needs to pay $30 million of tax to Canadian government. Because we know that the firm needs to pay total tax equal to the Canadian tax rate. However, the firm will get this $25 million of tax credit, which means in the end, the net tax liability to the Canadian government should be $30 million minus $25 million, right? So $5 million to the Canadian government. So to summarize, if this Canadian firm repatriates $1 million from the US, it has to pay $25 million of tax to the US. And then it will get this $25 million as a tax credit when it is paying Canadian government taxes. And before the tax credit, the firm has to pay $30 million of tax. And after the tax credit, the net tax, the net liability in tax would be $5 million. And you can see that in the end, the firm's tax would be 25 plus 5 divided by 100. So it's 30%, right? So it's exactly the same tax rate as the tax rate in Canada. So that's why we say all of the firm's earnings are taxed at the same Canadian tax rate, no matter where they are earned. And this will only happen if the foreign tax rate is smaller than this Canadian tax rate, right? Now let's think about the other case. In the other case, say the foreign tax rate is larger compared with the Canadian tax rate. So let's say, let's use a different country. So let's say a Canadian firm has a subsidiary in Mexico. Let's say its tax rate is 50%. And still Canada has a 30% tax rate. Now, in this case, firms have to pay this higher rate on foreign earnings. Right? That is, in the end, this Canadian firm has to pay 50% on this foreign earnings. Let's see how this works. So let's say, again, $100 million go from Mexico to Canada. Now, for this $100 million, the subsidiary in Mexico has to pay its host country 50% tax rate, right? So here, $50 million of tax goes into Mexico tax agency, right? And then, after repatriating this $1 million back to Canada, the firm will owe $30 million of tax to, let's say, Canadian Revenue Agency. Right? So the firm owes $30 million of tax. But now the tax paid in Mexico will become tax credit in Canada, right? It will have a credit of $50 million. But now the problem is the tax credit is larger than this tax liability of $30 million. And according to Canadian tax law, if tax credit is larger than Canadian tax owed, then the firm does not need to pay tax. However, the extra tax credit cannot be used. It will be waste, right? It will be wasted. So in this case, you can see that what happens is this firm pays $50 million in Mexico, and it pays $0 in Canada. So in the end, its total tax payment would be $50 million. And you can see that its effective tax rate is $50 million divided by 100, which is 50%. So you can see that you will get a quite interesting result here. That is, so in this case, right, if foreign tax rate is smaller than the domestic tax rate, the firm will pay the domestic tax rate. If foreign tax rate is larger than the domestic tax rate, then the firm will have to pay this higher foreign tax rate. This basically means that the domestic firm will never be able to enjoy the lower tax rate in a foreign country, right? Because we have seen that if the foreign tax rate is 20%, in the end, the firm needs to pay 30% domestic Canada tax rate. So basically, if a firm has a subsidiary in a foreign country, and if the firm decides to repatriate income from this foreign subsidiary, the best case it can get is the domestic tax rate, this 30% Canada tax rate, right? No matter what is the tax rate in the foreign country. So, a special case in Canada is if this foreign income comes from a country that has a tax treaty with Canada. then this income is not taxed when repatriated into Canada. So in this case, it basically means that if this Canadian firm has a subsidiary in a foreign country, and if this foreign country has tax treaty with Canada, and if this foreign country has a lower tax rate than Canada, then in this case, the Canadian firm can enjoy a lower tax rate from the foreign country. And this will only happen if there is tax treaty between the foreign country and Canada. This will have important results to firm behavior. That is, whether firm will want to bring their foreign incomes back, or they will want to just park their foreign income offshores. The other example is the US. So remember that in Canada, if the foreign income comes from a country has a tax treaty, then the income will not be taxed when repatriated to Canada. But such treatment does not exist in the US, right? So this basically means for a US firm, if it repatriates foreign income from a foreign country with a lower tax rate, it will still have to pay this higher US tax rate. So this will create enormous incentive for US firms to park their earnings offshores. For example, so I got some data points from Wikipedia. So you can see that a lot of famous US firms, they park huge profits offshores. Right? You can see that for GE, it's 110 billion profits in 2013. For Apple, it's $252 billion in 2018. So this is roughly 3 to 4 times of Apple's annual earnings. So Apple's annual earnings is about 60 to 70 billion dollars. Right? So basically, Apple parks 3 to 4 years of its earnings offshores. Right? It's a lot of money simply because of this. How repatriated income is treated in the US. Okay, that's for today's lecture.